been asked to share with you a little bit about what's been going on, what some of the trends and challenges are in the market for private equity transactions in the segment of the private equity world that we play in, which is what's defined as the low end of the middle market. And there are defined middle market, right? S&P defines it as businesses that, I think with the small end of the middle market to S&P is businesses with $25 million of EBITDA or less. We're even smaller. We're looking at businesses that have EBITDA of between $1 million and $5 million in manufacturing and value-added distribution primarily. And I say that, and then you look at our portfolio, and we've got consumer products and telecom and financial services, but that's okay. But I've been asked to share with you some of the trends that we're seeing in that market for private equity transactions, and to share a little bit about our firm and what we believe it is that makes us different and uniquely positioned to create value in the context of some of those trends and challenges. So is there anybody here today who's feeling warm and fuzzy about the state of the capital markets? Anybody? Anybody? Anybody feeling particularly optimistic about the state of the economy over the next 12 to 18 months? Anybody? No? Well, these dislocations that are happening in just about every facet of the market, they're presenting some interesting challenges in today's deal environment. If you look back over the course of the last year, there's been a lot of banter, and Sean talked about the presidential election, and we're hearing a lot about how the economy is tanking if you're listening to certain candidates. That hasn't been our experience as we've been working with our consulting clients and as we've been looking at businesses in the low end of the middle market. We're not so much seeing that the fundamentals of the economy are particularly challenged. Now, and let me explain what I mean by that. We're not seeing demand pulling off. The businesses we're looking at are actually doing okay on a unit-for-unit basis in terms of demand. Are they struggling with exposure to commodities markets? Are they struggling with energy prices? Are they taking a hit to earnings as a function of their inputs being more expensive? They are. And that's been very challenging. But we're also seeing a fair amount of pricing power. The folks who are well-positioned, who are good marketers, who have created value for their customers, have been successful pushing through price increases multiple times over the last 12 to 18 months. So when you think of it in that context, the economy, the fundamentals of the economy, from where we're sitting, look okay. The challenge, and it's really starting to manifest itself more today than ever, is liquidity. Right? It's access to capital. And we've got a business out in California that's in the telecommunications equipment business, and we've had these great relationships with contract manufacturers where our cash cycle is very positive. And all of a sudden, in July, we get told that we're going to have to put a $750,000 deposit down on raw materials to meet a delivery date on orders because our contract manufacturer's bank decided that they wouldn't fund the working capital to build our product for us. That was a shot to the head. We've got a business here in town, a $25 million business, 10-year-old company, rock solid credit, strong balance sheet, default rates on its receivables less than 1% historically. Had their bank come to them and tell them that not only were they going to reduce the availability on their receivables, but that the pricing was going to go up, and effectively told them they needed to find a new bank. They didn't want to be in their business segment anymore. These are unprecedented actions, right? And so businesses that may otherwise be performing reasonably well in today's environment are really now struggling to fund their growth and to fund their business. And that's creating some interesting challenges. And so, whether you're a seller or a buyer, or you're simply operating a portfolio company, you face some fairly significant challenges as of late that are somewhat unique. So what are some of the trends that we're seeing that are affecting private equity transactions in the market that we're facing? There are primarily three things that we've seen that are driving the day. One is that liquidity problem, and we'll get to that in a minute. There's this concept of repricing of risk, which we've heard so much about. It's even made its way into the mainstream media. I was watching the Today Show the other day, and I actually heard those words come out of Meredith Vieira's mouth, and I almost fell off my chair. And then there's the issue of transparency. So let's start with transparency. This really started 4 or 5 years ago. The end of the market that we play in, these little companies with EBITDA of $1 million to $5 million, traditionally were sold or bought in negotiated transactions between buyers and sellers. It was a highly inefficient market, which candidly is what made it somewhat attractive. But over the last 4 or 5 years, we've seen a level of sophistication, a level of efficiency and transparency come to that market. What does that mean? It means that we've now got broker-dealers who have moved their way into that low end of the middle market and are now bringing a much more sophisticated professional approach to marketing these businesses and negotiating the transaction with sellers and buyers. They're taking them from negotiated transactions to either limited or full-blown auctions, which is ratcheting up the selling price. We've also seen a fair number of more formalized private equity players, more institutionally backed private equity players, moving into that market space. There's one here in town called Riverside that's got a fund that's completely focused on what they call the microcap. And they've done, I don't know, Al, what have they done? 25 deals this year already or something? I mean, so there's a level of sophistication, there's a level of transparency, there's a level of efficiency that's moved into the market that has brought multiples, purchase price multiples, up considerably. So transactions that 3, 4, 5 years ago would have sold for 4 times EBITDA are now selling for 6, 7, 7.5 times EBITDA. So that's the transparency issue. You've got this repricing of risk, as they call it. Well, what does that mean? It means interest rates went up. That's what it means. We're seeing senior debt pricing, since this time last year is up about 50 to 75 basis points. But where you're really starting to see the repricing of risk manifest itself is on the subordinated side. We were doing a transaction about a year ago where we secured a commitment from a subordinated lender at 13% with no warrants and very, very small success fees on the back end. Well, we're seeing a much more traditional approach to subordinated lending today. The mezzanine term sheets that we're seeing today are back up in that 14-15% range. Traditional warrant structures are back in vogue. Success fees are back, and monitoring fees are much higher than they were even just a year ago.